Yes, so you had asked what we had done in the last class, right?
Yes, yes.
Sir, I don't know if I was in your last class, but in the last class that I was there, we had done event study. You had caused an event in the middle, and then we had done
No, then you have missed one more
one
class in
class.
between. Yes.
Yes, sir.
Okay. What we did in last class? Anyone? Those who have attended last class? Anyone? Muskan, Sahaj, Rajaditya, Jaideep. Srivardhani, Sahaj, Subham Jain, Subham Kumar. I think Srivardhani was there. Apart from Srivardhani, who were there? Imansi, you were there in last class?
No, sir.
Okay. Okay, Srivardhani, what we did in last class?
So we discussed the assumptions of the capital asset pricing model and the way the risks systematic and the way it explains the systematic risk in relationship with the market risks on the portfolio.
Yes.
Then we also did an example of the same, and then we started with the introduction to the Pharma French model.
Yes. So we have seen the capital asset pricing model, the theoretical framework. Okay. Then its assumptions, or how it is being built up. Then we have seen the market model. Under this CAPM, we have also seen what is this CML, that is capital market line, and what is SML, securities market line, and how risky both the systematic and unsystematic risk are being captured. Then we have come out with market model. Then we are just introducing the Pharma French model. Pharma French three-factor model. Yeah. What is this difference between these two model, Kappa model and market model? Anyone?
Sir, I'm not sure. Maybe because I think the intercept is like one is RI and RF based, and one is the difference between the two of them.
Yes, the CAPM is difference between two of them. Suppose I say RI equals to alpha plus, or simply say RF plus beta into RM minus RF. Okay. Then the market model is saying only RI or RP, either portfolio return or your individual securities return. RI equals to alpha plus beta RM only. Okay, only it depends on market. We have done through R also, this Kappa model and market model. Srivardhani, any doubt on that you have run through?
Yes, sir, I could run the model.
Okay, so we are getting the beta and alpha of both the models. Now, what is the use of that? If we use this market model, we'll see something called we did one regression. Okay, and on this regression we came out with the result of regression. Kappa also one of the regression. We did that regression. Now we'll do something called rolling window regression. All of you have heard about this rolling window regression. What is difference between this regression and rolling window regression, and what is the significance of it? Anyone?
Sir, I'm not sure, but I would like to guess that the beta value keeps on changing over different periods, and the beta
Exactly.
it depends on a certain window of time.
Yes. So what we are taking is one window, and we are just rolling that. Sorry, we are just rolling that window. Okay. We are taking one window and we are rolling over that window. The important part is how the beta is getting changed or how much it is getting impacted. Okay. So whenever we are measuring that, we come out with, suppose say you are taking 252 days rolling window. So whenever you have say 2000 data sets, 2000 number of observation, first regression will consider with 252. Second, it will drop one and add 253. So that will become also 252. Then second, it will drop, then add 254th. So it will cover all your 2000 by rolling over, but you need to decide what will be your rolling window. So whenever we decide that, all the so one problem with all these models is if you keep on increasing your data sets or the number of observations, then your result will also change. Yes or no? Whenever you are considering 2000 observations, you are getting one beta. Whenever you are considering 3000, 4000 observations, you are not getting the same beta. It is slightly different. So whenever you do this rolling window, you are looking after how much changes are there, whether it is significantly changing or it is mild changes are there, so that you will come out with a confident result. That is whole of the objective of this rolling regression. So this market model is a regression only we are considering return of I or return of security. Okay, then return of market. Then what we are doing is we are simply regressing and we are getting the beta and alpha value. If we do same thing through rolling regression, how much difference we are getting, we need to check. Okay, all of you are having this R file, that Kappa, Model and market model R file. All of you are having. And all of you also got the data sets. So open that R file. We'll first do the rolling regression. First we'll run through whatever we have done in last class quickly, so that we'll come out with the market model and we'll do the rolling regression. Then on the after the rolling regression, we'll move to Pharma French. Then after Pharma French, what we'll do is we'll move to event study through R. We have done event study through Excel.
Yes, using Excel we've done.
Using Excel we have done. We'll do event study through R today. So we'll do rolling regression, Pharma French, and it is called as popularly known as FF model. Then we'll do the event study. Okay, event study using R.
Sir,
Yes.
sir, how do we decide the rolling window?
Yeah, we decide. We do.
So, like how, by what factors?
It depends on us how we are deciding. See, it depends on how structural changes are happening in the market. So 252 days normally we take because yearly 252 trading days are there. So we are saying how it is year wise, how much beta we are getting, or yearly how much impact is there from market to our security. That's why moving that yearly basis. It depends if I feel that every 100 days structural break is there or any changes, drastical changes will come in the market. I can take 100 days as my rolling window. I can take 500 days as my rolling window. But again, you have to see also how many observations you have. If you have, say, 505 observation and you are taking 500 rolling window, that will not be good. So if you are having more observations and you are taking 500 window, that may give you some benefit or some value.
Okay, sir, got it.
Okay, Muskan was not able to attend. Okay, so all of you have opened your R file. Please open your R file.
Do you want us to open a new one, or the one that you have sent on our email?
Through email only I have sent. That title was Kappa Market Model from a friends. Yeah, earlier I have sent already.
All right, so we'll open
Not,
that.
not the new one. So you also download the data sets and keep it in one folder. Okay, all of you have opened.
So 1 second, sir. So you want us to open the R file called Kappa Market Model, right?
Yes.
Yes. So just give us 1 minute to quickly get that.
Also, you download the data sets.
Yes. So that's taking a little time. Yes, sir.
Yeah.
Done, sir.
Sorry, again my network was showing some error. Sorry. Okay, so all of you have opened your data file, right? Your R file. Now, just you just import all the data. Like you can follow. We want to get the return of Amazon. That is Amazon adjusted price, okay, or Amazon adjusted closing price. We want to get return of that. What we need to do is we need to so import the data like Amazon, and you just filterize that data and convert it into monthly data. So 2.monthly is used to convert this daily data into monthly and apply that in your file and get the return of that Amazon.monthly. Okay, so again you need to do the return through quant mode library. If you don't have quant mode, you have to install that quant mode and open that library, and delt is the function for the return. Earlier we have done during Marquis model, we have done the daily return, weekly return, monthly return command, and we have extracted return. The same way delt is also being used. So delt will give the return. Those who are new, that's why I'm repeating. You can you can run through, so that you will get the Amazon's monthly return file. Then you come out with Yahoo, then IBM, and you can create, or you can do the return and return extraction of all these three files. Then you do the portfolio return. Those portfolio return will be a combination of Amazon return, Yahoo return, and IBM return. Now the mean of those will be used for portfolio return, and you can just use that to write .csv, or you can save it in your folder, so that you can later on use this, or directly also you can start using. So first what we have done is we have named that as hypothetical portfolio return. So that hypothetical portfolio we save it and we use later on. So up to this, just run through once, those who are new, then we will proceed further. If you are facing up to this the problem, you will again we'll see if you are facing any problem. Then yes, once you are done, just raise your hand, so that we will proceed further. Only for Srivardhini, it's a repetitive thing. But for all of you, you can just run through once. Jaideep, are you doing? Jaideep, am I audible to all of you?
Yes,
Yeah.
sir, audible.
Okay, once you are done with, just raise your hand or write down in the chat box that you have done up to this hypothetical portfolio. Okay, done. All of you have done.
Yes, till 980, right? We have done the code.
Yes. Yeah. Up to line 79. Yes. Now we we want to do the Kappa model. For Kappa model, use that portfolio return as RP. You just either you read through, or you can use the same what is there. Then you come out with one we need is index return, that is S&P 500 index. You just import that GSPC data, that is S&P 500 data. Now you can calculate the return of that market, so that market return will be monthly again, two dot monthly, we are coming out with market return. Then once market return is there, we need one risk free return, because our formula is RI, or here it is RP, our portfolio equals to RF plus beta into RM minus RF. So this RM we got it. Now we need RF, that is risk free rate of return. So for risk free rate of return, we use that Fed rate, okay, that DSG 3 months Fed rate. So that Fed rate will be coming as your risk free return. That now you can use that, you can just filterize that RF or risk free return, and convert it into monthly. And whenever you are coming out with this type of yield or coupon, so it is annually, okay. Now since you need monthly, you need to convert that annual uh, interest rate into monthly interest rate. So that's how you can convert it into uh, monthly. Now that monthly will be used for the Kappa model. Okay. Now you combine all these market data and portfolio return and risk-free return, and come out with the calculation of excess return. That is nothing but the uh, how much we are getting excess return, how much we are getting, and excess to market, how much we are getting. Then we will come out with excess market, that is the risk premium, that will be used as a independent variable or input. Then you come out with doing that regression, that excess return on the excess market return, that this RP is you're saying RP minus RF. Okay, this is the excess return, this is excess market return. So now you say RP minus RF equals to that RF has come this side, beta into RM minus RF. Okay, this RF you just bring to this side. Now you are coming out with a summary of Kappa result, how much beta you are getting. So if you want separately, this is a coefficient. If you want separately to see beta and beta p value, you can also see that separately. Beta is 0.761 and p value is significant. Then you come out with adjusted beta, and that you will come out with the adjusted beta value. That is how that beta represents. What that beta represents? What is this beta? Can anyone say?
Sir, sensitivity of the stock, sir.
Okay, sensitivity of the stock means, what do you mean by that? If we are getting beta of 0.841, what is this indicating?
Sir, here beta is less than 1. It means, sir, a stock is moving less volatile than its index. I think, sir.
Exactly. Stock is less volatile than the index. Okay. If beta is more than 1, if beta is more than 1,
Sir, if it is more than 1, then it is a stock is more volatile than index, sir.
yes. So up to this, all of you got it, beta value of Kappa model? Yes or no? Up to
Yes, sir.
182.
Yes, sir, understanding. We just haven't run the code because you're looking at your screen, sir.
Okay. Just run the it will not take much time. It will not take much time. You can select at a time of a batch of code and just control enter. It will run through. If
Yes, sir, I think done.
yes, Neil.
Done, sir.
Yeah,
Up to code 181, 193.
not 193. Do up to 181.
So not an
So
issue, sir. I've not an issue.
yeah, yeah. You just I'll just explain this. This is nothing but market model from 185 onwards. Okay, how many of you have done? Can you raise your hand? Kirti, Neil. What about others? Subham, Manvi, Jaideep.
So doing.
Okay. So you keep on doing. Just I am explaining this market model. In market model, we are not taking that risk-free rate of return. We are saying RP equals to alpha plus beta RM. Okay. So only we are running regression with the market, that we are saying market is impacting to the or determining the portfolio return. That's how we come out with him. The independent variable is market, that is the market return, and the dependent variable is portfolio return. The simple regression you do and see the say see the summary of that regression will come out with beta value. You just see beta value we are here coming as we are getting as 0.761. There also we are getting 0.761. Yes or no? On the Kappa model we are also getting 0.761. On the adjusted beta also we are getting a 0.841. Here also 0.841. So we are getting the same result in both the cases, or both market and Kappa. Then why there are two models? So why there are two models? So it depends on how much risk-free rate of return we are using, or how much risk-free rate of return uh, is there that we are using to get the risk premium. So since 3 months T-bills are there, the risk-free rate of return is very less. That's how we are not coming out with more variation between these two, or more variation between these two results. Okay. All of you have done this market model. Then the next one is rolling window regression. Okay. Okay. Next one is rolling window regression. So in the rolling window, suppose we are taking 252 rolling window. Now you apply with all these Amazon or GSPC, and apply this rolling regression and get the rolling regression coefficients, and see how much it is different from the actual regression, or how much it is getting changed, or how much variation is coming in the beta values with different rolling windows. Okay. So run through that rolling window regression, then we'll move for Fama French model. You just run through that rolling window regression, then we'll move for Fama French model. So you have got the rolling window result.
Yes, sir.
So is there any changes in the beta value?
So there are different beta values.
Yes.
That's the first observation.
So what it is saying, what it indicates, if we are getting different beta values?
So over time, the sensitivity, as was mentioned, might be changing.
Yes. So it depends on different scenarios, the economic scenario or company specific scenario. So that's why over the passage of time, normally we say beta value will be constant whatever we have got the beta value, but it doesn't, because market reacts to several say announcements or events with the passage of time. That's why beta will not be constant. Now you can plot this to see the rolling window, uh, 252 days rolling window. So you need to simply expand it, rolling window regressions.
So if it comes with an error, and margins are too big, then how do we change that? How do
Just we need to expand this area, like
all
this
right.
plot area. We need to expand. I think I have increased the. So that is not a error. That is error is the to expand this area. Okay, so you can expand it and see later on. That is how to plot this beta and alpha. Now we'll go for Fama-French three-factor model. Before Fama-French three-factor model, we'll see something called arbitrage pricing model. Anyone has heard about this arbitrage pricing model?
Sir, I think it's like CAPM, but with multiple factors.
Okay, those which are those factors? So what it is saying is it was developed by Stephen Ross in 1970, and it's a alternate to Kappa model or extension of the Kappa model. The basic assumption is security returns are related to unknown number of unknown factors. That means it is not only market, not only risk premium. There are n number of factors that impacts the securities return. Which are other factors that impacts the security return?
Sir, inflation, interest
Inflation.
rate,
Yes.
growth rate,
Inflation.
sir, GDP, and so many factors are like those are macroeconomic factor mainly, sir.
Yes. So those macroeconomic factors has been included in this APT or arbitrage pricing theory or arbitrage pricing model. CAPM is a single factor model. Here we are adding the multiple factors such as GDP, inflation, tax rate, dividend yield, and other macroeconomic factors. When we add that, what we are getting is we are getting one beta for each of these regression or each of these variables. We just say macroeconomic. So you give different times like R1 minus RF, then R2 minus RF, and basic factors you come out with. So RJ is the required rate of return on a portfolio sensitive to all the economic factors. Then beta J is the stock that is the to the economic factor J. Then we come out with a different coefficients or based on different variable we are considering for our model. Now this model, this APT model has not specifically mentioned that you take these macroeconomic variables. There are n number of macroeconomic variables. Even so many macroeconomic variables are coming out time to time. So this APT is used in real world application, but the acceptance has been slow because the model doesn't specify what factors influence stock returns. If you take example, there are say economic policy uncertainty index is there, which measures the uncertainty policy uncertainty of a country. There are Centix global index, those are measuring the sentiment of the investors. Then we have risk based global stress index. Okay, that is the opposite of Centix index is global stress index that measures overall investment stress in all over in world. Global stress index, you can say. So those are new as macroeconomic variables. Global stress index, then Centix global index. Yeah. Then EPUI, economic policy uncertainty index. Have you heard about this EPUI? Anyone? Economic policy uncertainty index. Just see, one policy uncertainty website is also there. So this economic policy uncertainty index is an interesting index which is constructed based on three factors. One is your policy of your central bank. Second one is policy of government. Third one is how much risk news is there, like how many news are coming out with the negative part or risk part of news. So it collects news or the sensitivity of news from the top 10 newspaper of a country. RBI regulations, it collects the regulation and construct Government of India regulation and construct that index. That index is the parameter whether the uncertainty or policy uncertainty is low in the country or high in the country. We always look into low policy uncertainty because we want a stable economy, not a unstable economy. So you can get those data from EPUI policy uncertainty. So economic policy uncertainty index, the policy uncertainty website is there for all over world. You can see for each of the countries you can see. So if it is going up, it is good, or if it comes down, then it is good. This policy uncertainty, if it is going up, it is good, or if it comes down, it is good.
Sir, I think if it's going up, it is getting more uncertain, so it's bad.
Yes, if it is going up, it is bad. Yeah. So that is how we come out with this type of new age macroeconomic indicators. When you are going forward to join in industry, you will also come out with again new say developed macroeconomic indicators. But this APT model has not mentioned how many or which are the macroeconomic factors you will consider. So for risk return model, to find a theoretical model or empirically verified and easy to use this APT model. But what happens, we come out with something called Fama-French model or Fama-French three-factor model. Now Fama-French has also come out with four-factor and five factors models. So what this factor model is, beta is beta 1 or market is one of the factor, beta and 2 market return we call it is. So this is one of the factor. Now we are adding other factors and we will come out with this is beta 1, another will be beta 2, another will be beta 3. If we will keep on increasing our factors, we are getting 1 say coefficients for that or 1 beta for that. What it is saying or why this Fama-French three-factor model came into picture whenever Kappa model and market model were there. When Kappa model was there, they were only depending on the risk premium or on the market. Have you seen anyone of you, those who are investors, you have seen like whenever we invest, our stock price will also go up. But that doesn't happen always. For some stocks also it comes down. Some stocks, if majority of stocks are going up, but there are some stocks they are also coming down. So if we consider other factors, other major factors to build up our model and come out with a coefficient, we can confidently say that yes, this factor is impacting this much, market is impacting. Apart from market, there are n number of other factors that are impacting. So this is called Fama-French three-factor model. What this three-factor model first developed with three-factor. What this three-factor model is, we will take the size and we'll take the value, size and value. So we have something called SMB, that is called small minus big. What is this small minus big? So it is depending on the market capitalization, or we call it as market value of the market capitalization or market value of the equity. Now you say, what is this small minus big then? Now return of small minus return of big. In terms of what? In terms of market capitalization, which are having low market capitalization are coming under small category, which are having high market capitalization are coming under large category or high category. That's why small minus big, or it is popularly known as SMB. And all of you are aware what is market capitalization is? Yes or no? What market capitalization is?
Yes, sir.
Okay. Now you see another factor in three-factor model is H. So first one is S, that is small minus big. Then second one is H, that is high minus low, or we call it as HML. SMB small minus big, then HML high minus low. What we are doing over here, with high book to market ratio and low book to market ratio. So using market equity and book equity minus the return on that large, then a portfolio of firm with a low book to market ratio. This return that we generate over here is called as RHML, okay, or H minus L. That means high
So you're getting stuck, sir.
minus low. Now,
So you're getting stuck, sir.
am I audible?
So now you are, but your voice was lagging or for
Oh,
last 2-3
so
minutes.
from where my voice was lagging?
So you started with HML,
Huh.
and after that nothing was clear.
Okay, okay. I'll test it. Now, am I audible?
Yes, sir, you are
Yeah.
now.
So we are discussing this vector that is called S or small minus big. Okay, that is in terms of market capitalization. This you are able to understand clearly.
Yes, sir.
I'm so sorry. What is happening? Again, I got disconnected.
Yes, sir.
So maybe turn your charger off or turn your charger on.
Sorry, no. Charger means I'm connected with Wi-Fi. I don't know why today it is too unstable. Okay, if next time it will happen, then I'll change to my mobile. Okay. Okay. So these three things we are getting is one is for Rm minus Rf that we are using for Kappa model.
So you're not sharing your screen.
Okay, so what we are getting is we have three factors now. One is Rm minus Rf that we are using in case of Kappa model, that is beta 1. Now small minus big in terms of market capitalization, that is called beta 2. High minus low in terms of market to book ratio, and that is called beta 3. So you give any name to beta 2, beta 3, C, D, E, but the base is this small minus big, high minus low, and Rm minus Rf. So this is called as three factor model, since three factors are there. Okay, then we will come out with a return of I or Ri. Now you say this beta 1 you are giving, or beta I, Ci and Di. This beta I is the sensitive to stock, I to the market return, Cj or Ci, okay, Cj is the sensitive to of stock I to the size factor, that is market capitalization, then book to market factor, sensitivity of the stock to book to market factor. If we are saying like beta is 0.9 and risk free return is 6.8, then risk premium is 6.3, C is say that size factor is minus 0.5, and we'll come out the expected value of the size factor is 4%, then DI, that is the book to market ratio, is minus 0.3, and the expected value of that is 5%. Now how we will come out with the return of the security? You just add and multiply all the factors. This risk premium beta into Rm minus Rf, then you come out with the size factor, then you come out with book to market factor, then the return is coming as 8.97%. Now we can use that in our R, how we are getting this. Now where you can calculate this Rm minus Rf, or small minus big, or high minus small minus big, and high minus low. This is HML. Okay, so you can calculate this, or Gamma French has developed one website that is readily available with all the stock price, high minus low and small minus big. IIM Ahmedabad, you have heard about Professor Jacob Joshi or Professor J.R. Burma. They have developed, Professor J.R. Burma, Professor Jacob Joshi, and one more professor has developed one website. They are maintaining, means they are updating frequently. They are maintaining this Gamma French data sets. You can see, simply say Gamma French data, IIMA will come out with and this Kenneth has also done globally, and in India will come out with this IIM Ahmedabad data library, and you can get factor return plots, draw down tables and plots. So you will come out with, this is the result only. You will come out with yes, daily data. You will be able to see each script wise all the data sets that are small minus big and high minus low. So you are getting small minus big, high minus low, then RMRF, RM minus RF. Okay, this is the fourth factor, that fourth factor, and again fifth factor has been developed. Yes, you can see in this data set the date is there. The company name also comes with one company code. You will get the company name somewhere. Okay. Company name with all those dates. Somewhere in this website, somewhere you will get it. So either it is better you calculate it yourself so that you will know how you are calculating, just like we are doing RL minus RF. But if anytime you are not having access to databases like ProS or other databases, you are not able to extract data, you can use that IIM Ahmedabad, and you can use the data library of all over world by Kenneth. So you can use also this data for the return of many of the countries and get the permafriends return. Okay. Now, if we apply only Kappa model, we are getting 12.47% return. In permafriends, when we are applying, we are getting 8.97%. Now, which is good? Which is stable? Yes, which is stable. So in permafriends only we are applying 3 factors and we are coming out with less return. When we are applying Kappa model, only 1 factor, we are coming out with 12.47% return. Which is good. Am I audible? Am I audible? Kirti?
Yes, sir, you are clearly audible, sir.
Yes. Okay. So the question is which is good or which is more stable? See, whenever we are coming out with 2 different models, we are getting 2 different returns. But the problem or the thing is, this one is using 2 more extra factors and it is showing 8.97%. And this one is only using 1% only. So you can depend on whichever is using more factors to determine our return. So this permafriends is more stable than Kappa. That's why nowadays permafriends is has got good popularity, and permafriends got Nobel Prize for that only. Okay, for developing this model. Now we'll come out with doing this thing through R, and first we'll do this permafriends model. Now one file is there in the dataset called FF Research Data Factors. You can import that data. Then we'll we'll use that data for our analysis. Okay. So first use that data and see how is this. So suppose you have created 5 portfolios. Now you come out with 5 different names. Say one is date, another is RMX minus that is market return minus risk-free return. Then SMB, small minus big. Then HML, high minus low. Then thereafter RF or risk-free return, just name it. Then you can see the head and tail. Now you can convert it into h.numeric, and we need to do the subset. we need to do the subset to the specific time period. Then suppose you want from 11 to 13, just do one subset. Then combine portfolio return data and pharma friends return data. So portfolio return and pharma friends return will become 1 5. Now you see, one is portfolio return, another is another is that excess return. So we want to run this pharma friends model. So you can say we have given this name as ff.data, the portfolio.data. Then this ff data is dependent variable, and rmx rf, that is the risk free rate of like risk premium. So we just deduct from market return to risk free return, then small minus big and high minus low. Then you use data of pharma friends, and you will get the regression result for pharma friends. Okay. So you are getting 1 coefficient for RM minus RF, then small minus big and high minus low. Okay. How does it, or what does it indicates? So can anyone say what does it indicates?
So you're talking about the minus 1.06?
Yes.
So that means when you move from a high to a low stock, and sir, high to low, I think it's in terms of book value. Then the are you asking about the t value, or are you asking about the coefficient value?
Yeah, your coefficient, not
Oh,
T.
sir. Okay. That basically talks about how significantly different is it from. Okay. This value. So that means that minus 0.402 is the change, is the difference between a high book value stock and a low book value stock.
Yeah, this is the coefficient of high value minus low value. What it indicates? I hope all of you got the result till this, friends, 295. If you have not got, you just run through once.
So that means when you move from a low book value stock to a high book value stock, the RI change drops by a factor of 0.04, 0.4.
Okay.
Maybe, I'm not sure.
Okay. Anyone? Anyone? So what does this mean? RMX RF. Just see, we have seen. Yes. Now you connect these three things into that three different results. So for beta 1, suppose we are getting, we'll just take this. So this beta 1 is 0.66. What is this beta 1? Sensitive to sensitive of stock I to the market return. So how do you interpret this 0.6687? You have done with the Kappa model also, with the market model also. In market model, RF was not there, but it was similar. So what does that RMX RF?
So the RM minus RF is, I think, is called the risk premium.
Yes, risk premium. But what is this 0.66 is telling us?
That means, sir, over and so beta 1 being 0.66 basically means that one second, sir. RM minus RF
Hmm.
being 1 unit. So just hold on, sir.
Hmm. You are coming into line. Others can also try. Yes. Neil.
Sir, uh, basically, sir, to get an Ri which is 1 unit above Rm. So just let me restructure my thoughts once.
Yes, please, please take time, take your time. What about others? Srivardhini?
Sir, the excess, sir, the difference is actually the excess return, na, sir. Rm minus Rf, sir. So the 1 unit increase in the excess return leads to 0.66 per unit increase in the Ri, sir.
Yes, that is the simplest form. So that is how we are saying it is the sensitiveness of the market. Okay. So you can say sensitivity of stock I to the market rate. Second one is to the size factor. So how do you this size SMB? How do you interpret this size factor?
So same, sir. 1 unit increase in the size SMB leads to 0.47 unit increase in the Ri.
Come again.
Sir, 1 unit increase in the RSMB, the risk of the SMB, sir. So return of the SMB leads to 0.47 unit increase in the RI.
Yes, correct. Now, how book to market?
Sir, here 1 unit increase in the RHMB leads to decrease in 0.4 unit in the RI.
Yes. Now, Neil, you are getting what Shubham was telling?
Yes, sir. Yes, sir.
Yes. So, we came out with these three. There are 5 factors. Even some other researchers are developing another factor called earnings or the employees factor. Some are including ESG factor. Some new things are coming up, but Pharma French has developed 3, 4, and 5 factors. Okay. Now all of you are getting this Pharma French result. You can compare this Pharma French with say with the Kappa model and see how much difference you are getting in the same RMX that RM minus RF was is 0.66 in Pharma French, but it is 0.76 or what 0.73 in the Kappa model. Okay, there are differences, but what we are more concerned about is we depend more on Pharma French model as compared to the which model? As compared to the Kappa model. Yes or no?
So could you
Yes,
repeat
sir.
that statement once, please?
Sorry.
Repeat the statement once.
So we depend more on Pharma French model as compared to Kappa model. That's why in the industry also Pharma French is used widely as compared to Kappa model. Actually, Pharma French has been developed. The base was Kappa model. Then Kappa model was one factor. That's why this 3 factor, 5 factor came into picture. Okay. Clear, Neil?
Sir, but I saw Kappa model more frequently used in various business problems like
Those are only measuring the impact of RM or the market, but
yes.
those are all say either you can say positional traders not the long-term investors, maybe positional traders or swing traders. Okay. But if you look into the deeper way for the long term, this Kappa option is more used.
So
Kappa
like
is having
in the,
its merits. I'm not saying Kappa is totally false or total. It is having demerits, but Thama French is preferred over Kappa model. That is what I'm saying. Yes, Subham.
sir, but like in this scenario of the corona and pandemic, sir, when the all the macroeconomic indicators are working very not in a systematic way, sir, then to measure the business issues and the returns from them, sir, which model is more predictable, more accurate to measure it, sir?
No model.
Okay, sir.
So
Sir, can we say that
this is
this is an
called,
example of black swan? So like this
yeah, this
scenario.
is Black Swan only.
Yes, sir.
This is Black Swan only. We have done Black Swan conference. We has done Black Swan conferences also. See, if you observe this from pandemic to, that means starting a pandemic to till now, market is not following any fundamentals. So this is one exception during the emergencies or during crisis period. So market will not follow any of the fundamental. That is why it is not, none of the model is working, or all these macro factors. Even many times we have seen RBI governor also tells that the market is not following macroeconomics. There are so many economists they are mentioning market is not following macroeconomics. When macroeconomic are coming down, then market is going up. So the basic idea behind market bullish run on market is people are having now lots of surpluses. When they are not using for transportation, traveling, or going for outing or going for a tour, they have more surpluses. They are sitting at home, working from home, so they want to use that surplus in a investment mode. They want to convert that surplus into investment mode. So that is how so many retail investors came into the market. Around 1.5 crore plus retail investors has newly opened their demat account. That means during this 1.5 year, 1.5 crore accounts has been created, or new demat account has come. So there are other factors that runs the market, that is their surplus and bullish run. Like all are expecting that things will come to normal. So if we participate now, we will come out with good return. Further, market will go up. So that is how. Okay. Okay.
So,
Yes, Kirti.
so I understood the interpretation part, but I would like, can you explain more on the factor part of it? Like the three factors that are the firm size, book to market ratio, and market index, I guess.
Okay. So when we come out with this, this is RM minus RF. It is called as risk premium. It is market return minus risk-free return. Why we take this market return minus risk-free return? Because we want, suppose without taking any risk, whatever return we are getting is called as risk-free rate of return. If we are taking some risk, we should get higher than the risk-free rate of return. Then only we will take that risk or we will invest that. That is why it is called risk premium. So that RM minus RF. It is widely again used. Now the question is, which one will be RF? Which one will be risk-free return?
Sir, treasury bills, sir. Sir,
T-bills, okay. In
91
T-bills,
day, sir.
yeah, either you take 91 days T-bill, or you take overnight MIBOR, or you take GSEC. All are called as say risk-free rate of return. Now, one adjustment you need to do. All these rate of return are per annum. They are decided, or they are being calculated per annum. Whenever you are using monthly data, you need to convert that return into monthly. When you are using daily data, you convert it into daily from say 252 trading days, we say, out of 365 days in a year, 252 days are the trading days. So you take those trading days, or many are also considering 364 days. You can also consider that. That is RM minus RL. Now this small minus big means in terms of market capitalization. Market capitalization is nothing but price of share multiplied by number of outstanding shares, okay, or number of free float shares. So if the price of the share will go up, market capitalization will go up, keeping the constant number of outstanding share, because outstanding share will not increase. Whenever price will comes down, then market capitalization will come down. The index, the major index that you are seeing are large market capitalization or large cap securities. Okay, large cap securities. Okay, so you take large cap securities return as well as small cap securities return. That is how it is, small minus big. Then you see oh, don't know what is happening today. So where this net got disconnected, where we are there. SMB,
Sir, you were explaining SMB.
SMB. Okay. This SMB is small minus big in terms of market capitalization. You take small market capitalization stocks and big market capitalization stock, and you just take return of those two and come out with one return series. That is called small minus big return. Then you take high minus low. This is not HMB, this is HML. High minus low, you take, that will be in terms of book to market factor, or book value to market factor. Now that HML will give you what is the sensitiveness to book to market factor. Now you will come out with the three factors and get how your return is getting impacted through these three factors. Okay. Kriti, you are getting? or who was asking?
Yes, sir, got it.
So if you come out with this, you are getting the Friends result. Now second one is we'll do the last one is today's is event study through R. We have done the event study through Excel and how this event study is helpful. Srivardhini, you got the recording?
Yes, sir, I got the recordings.
Yeah. So you can try that event study. That is very powerful tool for measuring impact of any of the events. Okay. Now you come out with one event study for Netflix. Will take and you can take one date as event and come out with event window, estimation window. I'm sure all of you are aware about what event window and estimation window is. What event window and estimation window is. All of you are aware. Yes or no? What is event window and what is estimation window?
So event window is the time period when the event is happening, and we usually take plus minus few days. And estimation window, we take time before or after of that, and we calculate the betas on that, and then we try to see if there's significant difference between the two.
No. Come again. This estimation window is before and after.
Yes, so estimation window is before and after.
And event window?
Actually, sir, in some cases it's only before the event, and we so there are two methods of doing it. Either you can do before and after, and if you
Yes.
do before and after, you try and see if the betas are significantly different or not from each other.
Yes.
That is one way of doing it. The other way of doing it is you only do before, and then you use the created model on the input from the after data, and then you
Yes.
see if the errors are very large or very small, or if they are according to your preference or not.
Exactly. So we consider estimation window to get the alpha and beta by applying either Kappa model or market model or Kappa model or Friends model. Also, you will come out with three different betas for three factors. Then you take three different abnormal return for 1, 2, and 3. Then event window will give you say plus minus 5 or plus minus 10 will give you how much change is happening or how much it is this event is impacting to before and after. Okay, so we'll do the same thing over here. Whatever we have done in the Excel, through Excel we have done, you can read through the like same way this is explained what is event window, how for which period to which period, estimation windows period, and take this Netflix data, import this Netflix data, then you can convert it into date and create one date column and just filterize and keep this data. Then you come out with the S&P 500, that is market data, and ETF data can be considered as risk-free rate of return. Now you have market adjusted and farm and market adjusted. Now you calculate the return of Netflix and as well as market, that is SPY, will come out with return. Then perform the market model because we need the alpha and beta from the market model. Then you will come out with a summary of the market model or the result of that market model. Now we need to calculate the abnormal return in the event window, and we use this alpha and beta coefficient to calculate the expected return and we come out with the abnormal return in the event window. Now, whenever we do that, we'll come out with a whether this has impacted or not impacted. This particular event has impacted or not impacted, and we'll see if it has impacted, how many days it has impacted. Anyone got the plot? Actually, I have done this bigger size. Sorry, I have to do zoom out. So you calculate the abnormal return. One. Okay, that I need to adjust my plot area, but you can get those say data sets of farm return and market return. Then you can come out with whether it is given you abnormal return or not, abnormal return window. Then do the summary of that and come to event window, how much has been you got the return and the t statistics and p value. So you can say that based on t stat it is not significant, but market has given abnormal return was minus 1.45. That means market your stock has given lower return than the market return. Okay, all of you got this result of event study.
Yes, sir.
Okay. So next class, maybe next Monday, this October Monday, we may not do. From October end, we'll start Monday classes. But regularly we'll do on this Saturday. Whenever Monday will be there, I'll tell you one day before. So next we'll move to uh, the probability value at risk, and then we'll move to fixed income derivatives. Okay. So thank you all who are present. Just tell. So today is 9th. Okay. Akash. Akash. Anchal. Anchal. Ayush. Adyasa. Tejas. Ali Sagar. Only regularly attends. What happens? Anjali. Amol. Arismita. Avani. Ayushi. Sarvesh. Bhavya. Terry. Diksha. Dipans. Gaurav. Himanshi.
Present, sir.
Jaideep.
Present, sir.
Ayushi, K Ayushi, Krishnakant, Kirti,
Present, sir.
Mansi, Mansimran, Manvi,
Yes, sir, Manvi.
Mihir, Muskan, Namrata, Neil,
Present, sir.
Nikhil, Prasun, Pratik,
Present, sir.
Rachit. Who is present? Pratik. Pratik or Rachit? Who is present?
Subham Kumar.
Subham Kumar. We have not reached Subham.
So it was
Rachit.
Pratik.
Rahul. Pratik. Rahul Giri, Rahul Ghosh, Rahul Goswami. Rajaditya, Rasi, Rishabh, Ruma, Sahaj, Samiksha, Saranya, Subham,
Present, sir.
Subham Kumar,
Present, sir.
Someshwar, Stuti, Thakur, Sanika, Binay, Srivardhan is present. Okay. Thank you all. We'll meet
Sir?
on next. Yes.
Sir,
Yes.
I just
Gopal.
wanted to ask you for a 2-day extension for the assignment submission.
Yes, sir, please.
Okay.
So actually,
When it
we
was
had interviews every day this before this week, so that's why. Plus, we are having interview on 11th also. So, if possible,
okay. How
can you
many days
extend
you
by
want?
2 days?
How many days you want? By
So,
when you can
two
give?
or 3 days.
Okay. You give by 15th of this month. Okay.
Okay. Thank you so much,
Fine.
sir.
Thank you,
Sir,
sir.
Thank you.
I have some doubts regarding the project. Can I share my screen for just 2 minutes?
Yes, please.
Okay, sir. Sir, so, sir, is my screen is visible to you?
Sorry.
Sir,
Yes.
my screen
Yes.
is
Yes.
visible to you, sir? Okay,
Yes.
sir. Sir, so I have done this project in this way. Like, sir, library quant mode. Then I use the gate symbols. Like, I have extracted the data set from the Yahoo Finance, like Tata Steel, Wipro, ITC, ONGC, and sir, then I also taken the close
Nice.
prices
Nice.
of all these variables, sir. And sir, and to get the stock return, I use the library magnetor where I, sir, no, sir, I take the, sir, I asked you and you said
Subham.
that to take the close price. I also I can change it, sir. So which price is need to be taken, sir?
Take the adjusted
Okay,
close.
sir.
No, you have not asked me between close or adjusted close. You have just simply written whether close can be considered. I said yes. So whenever you are taking data from Yahoo Finance, you take adjusted close. This NSE is not giving adjusted close, but ProS gives adjusted close price. So adjusted close price will be more meaningful. Yes.
Okay, sir.
Go
So
on.
okay, I will make some changes, sir, in it. Then, sir, I use the library magreader where I actually use this function. It is the same as that to take the return, sir. I divide the x upon stock value of the one. Then, sir, this is like
Yeah, right.
I have, sir. Then I use the plot function to plot the graph, sir. Let me just show it, sir. Sir, this is how, sir, the graph shows.
Yes.
Then I actually change it to monthly, sir. I asked about this to you, sir, and you
To
said to
that
change.
monthly.
Yes,
To
sir.
that
Then
monthly.
yes, sir, to monthly, sir. So this is how I did, sir. And for the correlation part, sir, and this is how the log, so the log difference portion of the sir question, the log difference of the data set, sir. This is how I have done, sir. Is this correct, sir?
Yeah, yeah, correct, correct.
And sir, and the last point is this for the correlation. So this is how I draw the correlation map, sir, for the every data set that I have taken, sir.
Fine.
Sir, sir, actually it is different from what you have taught. Like I have tried
No
different
issue.
codes for this.
Yeah, yeah, no issue. Whatever
Okay, sir.
code you use or whatever way you do, whatever has been asked, you need to do that.
Yes, sir.
Okay. Yes. Good.
Thank you, sir.
Yeah. Okay.
So just a doubt.
Yes, please.
Whenever I plot my time series, I always mention the start and the end. But what happens is when it actually marks the x-axis, instead of coming as the date as it came in Shubham's July, December, and all of that, mine keeps on showing 1 to 500 because I have 500.
Yes, sir. Yes, sir. I have been. I also did it with the codes that you have given to us. So when we convert the data into time series, then actually data is indexed in index form, like 1, 2, 3, 4. And when we actually extract the stock returns, the CSV file is also showing in the same way. I
1,
have
2,
also
3, 4,
tried
yeah.
this, sir, and and this is our problem, sir. That's why I use this method, sir.
Yeah. Now there, what you need to do is you take date as one of the factor. Like you just say, like regression, you just say plot this one variable, then say tailed and date. So with date it will come the way we are doing. So you need to im- means give that date as one of the variable kind of thing that will come in the x-axis.
All right. But so when we do auto plot, that time it doesn't come. But when we do things like, let's say, ggplot, and we have to define x and y, then we can maybe use date as a factor. All right, sir.
Hmm.
All
Okay.
right. So, but sir, it's fine, right? If we have index numbers from 1 to 500, you will not.
Better do this date, that will be more meaningful. So
So,
whenever you
so
go
because
back to,
lots of the codes that you have given, like, sir, if I'm running similar codes, then I'm getting stuck with my index, even though I'm mentioning the
okay,
date.
you can report that index itself, but learn how to do that date as well, because whenever you go back to industry, people will ask you to give date wise.
Sir, any tips on how to do that other than marking it as in the x-axis?
Okay, other than marking it in x-axis means
Like
other
as you mentioned, take date as a factor.
yeah. So what you need to do is you'd say date, then tailed. That tailed we use during regression. Na?
Yes, sir.
Date tailed, then variable name. Just try that. Plot, then date, tailed, and the variable name.
So shouldn't we do variable name tilde date because date should be on the
Yes, yes.
x-axis?
Variable name, tailed, date. Yes. Either way, I just missed either this way or that way. Just see x-axis date should come, y-axis variable should come.
All right, sir. And sir, I have taken my data from NSE, so I will be going ahead with the close price. That's fine,
Close
right?
price. Yes. Yes.
All right. Thank you, sir.
Welcome.
Sir, I have done in both ways, sir, like the Yahoo Finance and the NSE. Can I submit my both of the files?
Yes,
It
yes.
would be
You are
okay, sir.
good. Like you are comparing both the things. That is good.
Okay, sir.
Okay. Thank you.
Thank you, sir.
Welcome.